Apple awaits us, but we've got a lot to dive into already here. The earnings bonanza of this afternoon continues with two guests, Rebecca Walser and Nicholas Mirisch, join me here to take a look at some of the biggest names. Rebecca's the president at Walser Wealth Management. Nick is a portfolio manager at Purpose Investments. Great to have you both here. Rebecca, get us started. How do these earnings fit into the generally cautious view you've been talking to us about from a macro perspective here over the last 9 months?
Well, I gotta say, I was really thinking that maybe, with Powell, the good news, and then with Meta, I was like, okay, obviously NASDAQ today thought we were going to go on a tech run. I had flashbacks of early 2000, but obviously the news out so far with what we've got with Google and Alphabet, with Amazon and Alphabet, it's expected, right? I obviously thought Amazon was not going to have some problems. I didn't expect the miss to be as large as it was, 17 cents to 3 cents. That's quite a big miss, and obviously in the midst of their layoffs. And obviously the Amazon problem is, where are the consumers going to be able to spend this year? Do they have the disposable income with inflation still a factor and entrenched now? What kind of, breakout could Amazon actually have outside of AWS, obviously? With Google, I want to resonate Nicole's sentiments exactly, in the sense that ChatGPT, you just had the founder, the creator of Gmail, say recently that he expects Google to be totally disrupted with ChatGPT in 1 to 2 years. And that is fascinating to me, because obviously their earnings, this actual result, it actually says exactly that, because what we saw was cloud revenue actually being stable, but we see the second drop for search revenue, which is their go-to. And while ChatGPT obviously is in its early stages, you can really do an analysis and see results from really technical searches on Google that return nothing. But then you've got ChatGPT breaking down in 4 paragraphs with diagrams. And so people are going to very quickly learn what this thing can do. We had 100 million downloads, I think, recently. It's taking off like wildfire, and Google needs to be worried. Yeah,
I think you think they'll address it specifically on the call, Rebecca? You think we'll hear the words ChatGPT or Microsoft? I've been surprised already how openly they're discussing the competitive risk to them.
Yeah, I think they have to be honest, right? Because they can't keep prognosticating this beautiful world of upward momentum and growth in search engine when they really are now the legacy technology, if you can believe that. And we're moving on to AI-based resources. And I just don't think that they're going to be able to bridge that gap as fast as they need to really be the next player in that realm.
Nick, I really like the way you describe the Meta situation right now, and I want to tie that into Alphabet here, because so far Meta's in a world of its own here this earnings season, where you say that the company went from move fast and break things to crawl slow and fix things. Market likes that fix word right now. Maybe it likes the slow word. You sprinkle in a little giant buyback, suddenly people are willing to wait around. Is there potential here that Alphabet could see the same degree of disruption to its bread and butter the way Facebook did from Snap and then TikTok and all the other applications that kind of ate into their market?
Yeah, absolutely. And I really think there are a couple nuances between when you come to the Meta earnings versus what we're seeing now here with Google. And it comes down to 3 really main things when you think about Meta. And they have changed their mantra from that move fast and break things to crawl slow and fix things, which I think is an impact of the overall market, really stressing this profitability metrics rather than this growth at all cost perspective. And if you think about Meta, the stock was really up over 23% today on 3 key drivers. And the bear case over 2022 was that total CapEx spend was getting out of control, whether it was data centers or the metaverse. Apple's privacy laws were destroying all the ROAS, the return on advertising spend metrics. And TikTok was really big, stepping in here as a competitive threat. All 3 of these trends that we saw over that Facebook quarter really reversed as Meta lowered the total CapEx spend projections going forward. They've really turned that ATT, the app tracking transparency, which was the Apple privacy issue, from a headwind into a tailwind. And the Reels metrics are really starting to catch up to TikTok. Stock now up over 57% on a year-to-date basis, but still only trades at 16 times PE and a 4 times EV to revenue. So really sort of stellar quarter for Meta there. But what we're seeing here is Google really did not have the same sort of problems when it comes to that lapping comps from that Apple privacy change, because they do have much more native sort of advertising spend. So they were more insulated from that massive change from the privacy side from Apple than Facebook was. And that's what really crushed them over 2022. But what we're seeing here now is really just that catch up on the advertising front when it does come to that pullback in spend, businesses are being more cautious. They're lowering their advertising budget. So this is really just sort of a pullback in that spend. And what we're seeing really, I couldn't echo more the sentiment in terms of this ChatGPT and the existential threat. They really do need to address this in the call, because you're seeing a lot of people just going and using the scraping technology to get right to the source material. It's not perfect. 75% of it maybe is great. You do have to tweak it, but this is definitely an existential threat.
Yeah, okay, I like that. Good phrasing here. And I think it's also important, as you point out, there is just kind of a macro headwind generally for advertising here that kind of hits everybody. But now we're finding out who really responds to it and how, and what the market prefers. I want to talk Amazon here and how they fit in, because that kind of macro slowdown for them is more an issue of slowing growth rather, than maybe an existential risk perhaps. But the kind of profligacy of their spending the past year has been somewhat shocking. The idea that Amazon has had losing quarters on the bottom line, Rebecca, in the last year, and then now tells us next quarter their low end expectation is zero? Like, what world is this where, like, one of the arguably best, biggest companies, it's like a flip of a coin whether or not they're even going to make money?
I think it's shocking and alarming to most retail investors that don't understand that their business model necessarily. But I think, really what you're looking at is the macroeconomic wins of consumers don't have enough disposable income. Besides their ADS and their cloud computing, which obviously is not what I'm talking about. They're just their core business of being, the go-to place to get whatever you need delivered, hopefully by drone in the future. That is going to be affected by all of the supply chain issues that we've dealt with, as well as the consumer disposable income. America has we are a 70% consumer driven and consumption society. And so what that means is when we have macroeconomics that don't allow for that to be, you could see an Amazon not make money, which for most of us is just alarming. And you say, where is this happening? But how do they change their business model to be workable and still make a profit margin when consumers can't spend in a country that is based on consumer consumption? So I think that's the problem. And Amazon obviously diversified and has other revenue streams with cloud computing and other things. But yes, obviously they have the Alexa, they have so much, but what can they do to actually give consumers the push to go buy again? I don't know.
Yeah, the consumer potential slowdown for the online sales, the deceleration of cloud post-COVID, and the fact that they've already kind of dabbled in some wild cards and fumbled, like Rivian, etc. To me, there's kind of this question of, well, what could surprise us positively? It's not like they have this big cash flow buffer zone that some of the other giants do. What do you think, Nick? Where does Amazon fit into the risk-reward of the big tech names?
Yeah, absolutely. And I think there's really a lot of trends going on here that are quite interesting. So I'll start with sort of the CapEx spend and the build out. And I think a lot of this through cycles. So if you go back and you look at sort of that CapEx build out throughout the COVID period, they did more in that time when it came to the fulfillment centers and everything else than they did in the previous 5 years. So this was a massive overcapacity build out when you think about just how much they were spending and really growing up and making sure that they can meet all that demand. Now what we're seeing is a complete sort of retracement of a lot of that demand. And a popular chart that was going around lately was just that a lot of the cardboard box companies and the shipping box and the container boxes themselves, they had seen drops in volume that were extremely drastic. And so what you're seeing is a lot of these leading indicators of these companies really having to be able to scale back. So, and not only on the employee front, we know that they kind of let go another 18,000 just recently on top of the previous layoffs as well. But you have to think about it in terms of CapEx build out, meeting that need, and really just sort of optimizing that. And they've been the kings of doing this, and I have no issue or I have a lot of comfort in terms of that they will be able to control that spend. So really confident in their ability to do that. But as soon as you have a narrative violation where the costs get out of control, it really is getting punished to the downside extremely, extremely heavily, especially in today's market. Another area just for Amazon that I did want to bring up is that AWS component. And a lot of what we saw was from the read-throughs from Microsoft that have previously printed. Everybody got a little bit jittery in terms of, okay, this cloud deceleration is real. It's coming down quarter over quarter, but it's still growing from a massive base when you think about just how large the scale is.
Sure.
And all the product innovations they're doing on the AWS side, I find extremely attractive. And they're completely covering a lot of the product suite that really has this full product suite that is a full press in terms of digitalization of these companies. So it's really a sum of the parts is always a little bit of a valuation and mental gymnastics to pull off here, but you really have to take the balance of those two.
Okay, point well taken. Great conversation, guys. Love the assessment and the integration of these companies into the big economic picture. Rebecca Walser, Nick Mersch joining us. Thanks a lot. Excellent setup for us for the rest of this week, thinking about how these companies fit in. Apple is going to be hitting here shortly, so we'll come back and we'll talk about it, get into the number here.